Right, I think we'll make a start. Welcome everyone to this Audit Committee meeting. We've got a lot to get through this evening. And I do want to make sure we allocate appropriate amount of time to the Audit Committee effectiveness item. So we've got sort of 5 major tranches of things to get through. So I'm going to suggest we try and stick to about 20 minutes on each of them, allowing 30 for the Audit Committee effectiveness. So I know we can stay here till 10:30 under the Constitution, but we'll aim to finish a lot earlier than that. So we'll keep things moving. So before we start, Andrew, could you just introduce everyone on the call just so that we all know who we are? Thank you.
Thank you, Chair. So online this evening, we've got Graham Cadle, the Assistant Director of Finance. We've got colleagues from our external auditors, so Helen Thompson and Hannah Lill. We've got 3 other officers online. So Mark Thompson from Finance. We've got Jackie Whitney, who's the lead on Customer Digital and Change. And we've got Sarah Zama, who's our head of digital. So they're the online officers, Chair.
Thank you very much. Okay, do we have any apologies?
Yes, Councillor Harper and Councillor Kaiser and Councillor Davis will be late.
Okay, thank you, but we are still quorate. Okay, moving on to the minutes of the last meeting. First of all, can I take an approval that these are a correct record before we have a look at the actions? Do we all agree they're a correct record? Could I just see a show of hands? Thank you. Then in terms of the actions, thank you for providing the actions list as we requested at the last meeting. Looking down the list, I think all of these have either been covered by a response from Finance by email to members or by Andrew and others. Just a quick update on the internal audit ones, as Catherine Hickman is not due to be here this evening. So middle of page 14, she will be providing additional information on how the risks are being addressed in her Q3 report. So she will be adjusting it in response to our feedback. She has confirmed there are no high risk overdue recommendations, and the community assets item will be considered in the 23-24 internal audit programme. So that's an update from Catherine. Are there any other comments on any of the actions? I don't want to go through each one individually, but anyone have any comments or questions on any of those actions, please? No? Okay, great. Thank you. Moving on. Any declarations of interest? No? And do we have any public or member questions? All right, then. So to start our main items on the agenda then. So the first item is the update on the statement of accounts. Now, I understand that we do have some progress on the infrastructure issue, Helen, that we will be okay to hopefully sign off on those at the next March meeting, but we're less sure on the pension side of things. So over to you for an update, Helen. Thank you.
Thank you very much. And that's a masterful summary, if I may say so, in terms of where I think we are at. But firstly, before I go into that, can I introduce Hannah Lill, who I'm hoping is going to pop up on screen, who is going to focus primarily on 21-22 and then our following audit in 22-23, but is also helping Fran and me close out 2021. So I'll just hand to Hannah so she can give you a little bit of background so that you know who she is and a bit about her.
Thank you, Helen. So I'm joining the team with, I trained with a corporate audit background, so I've got kind of significant experience in normal company accounts. Before joining the Audit Commission in 2009, and then transferring it over to EY with the contract. So I've got coming up to 14 years of public sector experience across a number of different genres, including police, fire, a number of different district and borough councils, and unitaries and London boroughs. I've also worked very closely with Helen, especially for the last 10 years across some very challenging audits, including groups. So I'm hoping that I bring some really good experience to your audit team to help move things on forwards.
Thanks, Hannah. So hopefully that will give the committee some reassurance over how we're trying to move things forwards over the last couple of years that we're in the contract with you, the current PSAA contract. So turning to our audit for 2021, which I am really very much hoping we are going to close out for the March meeting. Firstly, on infrastructure, the statutory override came into force on the 25th of December, so that was an excellent Christmas present for all auditors and accountants in the public sector everywhere. And alongside that, slightly earlier in December, CIPFA issued their update to the Code of Accounting Practice. And then about 3 weeks ago, they issued a bulletin which provides guidance to both councils, the preparers of the accounts, and auditors. And it gives some example disclosures. So we've got all the information that we now need. Since then, we have been looking at it as a firm in terms of what our approach needs to be, and we have been talking with Graham Cadle, Mark, and others about what we need to do to move this forward. So effectively, there's revised disclosures that will need to go into the draft financial statements, including sort of an updated accounting policy and various other bits and pieces. And then we also need to look at the depreciation methodology. So what we need to do in relation to that is to consider your current depreciation methodology against, to a certain extent, the examples set out in the CIPFA bulletin. Bearing in mind that obviously depreciation is an estimate, so we're not expecting a precise figure to emerge or to agree on that, but we need to be sure that it's materially correct. So that's the piece of work that we're doing or talking with the finance team about at the moment. Mark's provided us with an initial paper sort of summarising where the council is at, and we've got some meetings set up to take that forward. I think what is really important for us all to remember, so us as auditors, the finance team as the preparers of the accounts, yourselves as a committee, this solution is a temporary solution. This takes us through to the 31st of March 2024 effectively. So from the 24-25 year, that's when the CIPFA are expecting to have made a decision about how to take this forward. So I think we really need to keep our eyes on the issue of infrastructure assets. I suspect we'll put some form of recommendation into the audit results report around this, because we don't know what will be required by the time we get to April 24 and going into the financial year where the new code is expected to fall. So I think it's good news, and it does mean that we are going to be able to move that forward quite quickly, we think, now over the next few weeks. What I give with one hand, I maybe slightly take away with the other. So the pension fund, we still do not have a letter of assurance from the auditor of the pension fund, but after some chasing, we do now have a meeting with the partner at Deloitte, which is on the 9th of February, which I think is next week, because I've a bit lost track of my weeks. We have explored, and we are continuing to do so, our options, so whether there are alternative procedures. But on sort of the work that Hannah and I have been doing to date, all of those alternative options come with either a significant time element and or a significant cost element, and rely on the cooperation of others. So whilst we will continue to look at that, it's not an easy solution to try and find an alternative way around it. So I am hoping that next week we will be able to move things forward. I have been talking with Graham Cadle about this week, and he may want to add something in a moment, but I just wanted to conclude by saying, outside of those two key points, we've set some time aside next week to go through an updated audit results report. So I think we brought a version to the committee almost a year ago now. We need to update that, and we want to go through that in some detail with officers to start to pull that together into the report that will come to the next committee. And we will bring it to the next committee regardless of where we are with the pension fund. But Graham, I don't know if there's something you want to say around the pension fund or add to that point.
Thank you, Helen. The only thing I think you'd add is we are continuing to exert as much pressure as we can through the council and through the pension fund to move that forward with Deloitte. As Helen said, I think the baton's been passed between the two audit companies to talk to each other to try and resolve it on the 9th, but we'll continue to do that where we can. I think the other point we'd add is, I think last year we spoke when it was the infrastructure issue that we thought might be stuck, whether we could actually close with some kind of qualification. In the matter of the pensions, it's not as easy, and it would be a far bigger implication to close without resolving that matter. So that doesn't seem to be an option at this point. Thank you.
I don't know, Chair, if there's any questions that members have based on that update.
All right, thanks for the update. I will open up for questions in a moment. I would say the reports that you bring next month, it would be very useful for us if, as we discussed before, and in fact, as you've presented before, if you can be very clear in terms of what those options are and the impacts of those, just so that we know what we're sort of deciding on. And that's useful information about the qualification being difficult with the pensions. That's not something I was aware of. So thanks for bringing that in, Graham. Okay, members, questions, comments? Maria? Yeah.
For sorting out the overstatement of the cost and the depreciation. Do you have any view on that?
I mean, I completely understand the point that you're making, but I don't think I have an answer that I can easily give to that. I think it is important that both the council and ourselves as an audit firm continuing to engage with SIPFA through the consultation processes that will undoubtedly happen over the coming months. So my understanding at the moment is that there are potentially 3 solutions being considered. I don't have an awful lot of detail. Well, I don't have any detail, let's be honest, about either of those, but I know that we will be contributing to that as a firm, as will others, and I would encourage the council to do that and to make those representations about the time and effort involved in and cost involved in any one of those 3, or whether there is an alternative. So, but in terms of what it looks like, too early to say. We've kind of got to the temporary solution, so the next stage is what happens next. Graham, I think you probably want to comment as well.
Yeah, thank you. Chair, just to add, I think, as we've explained before, unfortunately, until we know what that solution is, any work we might do to try and get ahead of it could be wasted, because it might not tie into what that is. But we'd be as committed to getting that right. This is gut feel or kind of a bit of my own experience rather than anything else. But I think the reason a solution hasn't come out already permanently is because this is difficult, and I think SIPFA understand the complexity of trying to get something that's commensurate to the output. So it's accurate, as you say, Councillor, but doesn't cost, too much money and therefore, not use of good public funds. I think that's the complexity. Hopefully they will get right when they put something forward to us. Thank you.
I have a question about the sign-off of the pension scheme. So I sit on the advisory panel to the committee that looks at the Berkshire Pension Fund, and it appeared that there is no problem with the pension fund accounts. What they're waiting on is a sign-off from the administering authority. Now, this is something I hadn't understood before, that the pension fund can't sign off without the administering authority signing off. And I'm a bit baffled as to how long. What happens if Royal Borough of Windsor and Maidenhead never sign off? What happens if there's a really big problem with their liquidity or something like that? So I'd like to ask about that, because this is something that did perplex me, as I never understood this before.
Chair, I think we have mentioned this before in sort of previous meetings, in that no, our understanding from the auditors of the pension fund, and also officers' understanding from their discussions with officers at Windsor and Maidenhead, is that the pension fund work has been completed. The issue is that they have the letter that they sent us probably about a year ago as a draft letter had a caveat in it, and it said, we have completed our work, but until we have completed our work, I'm paraphrasing slightly, and until we have completed our work on the administering body accounts, there remains a risk of material misstatement. Now, if they did not include that phrase, there remains a risk of material misstatement, we would be fine. If they had said they had completed their work on the pension fund and there are no matters to report, and then they said, we are continuing our work on the administering body, kind of full stop, we would be in a much better place, because it is then our assessment as auditors, as the auditor for Wokingham, as to whether we can place reliance on the letter that they have provided. But because they have provided that caveat, we would be challenged if we had a quality review on, well, how on earth do you know, Mrs. Auditor, that there isn't a risk of material misstatement that they haven't identified? So the gist of our discussions really for the best part of a year have been around what's causing the delay, and is that delay fundamental to the pension fund accounts? And our understanding is that it's not, but we're not in a position to speculate as to why the letter is not being updated in such a way that would allow us to move our audits forward. Now, I am aware that some other committees and councils are starting to get quite agitated about this, as indeed are you, and are taking some action themselves. So in terms of I believe a couple of them have written to public sector audit appointments to ask why the delay. I can't really say any more, but it is in all I can say is that from an EY perspective, we do not hold up if we have completed our work on the pension fund and we are satisfied there are no material errors in the pension fund, we issue our letters to the other audit firms to say that we have completed our work, and that it is therefore then their responsibility to assess the risk to their audit.
Okay, if we could just have one more question, then we need to move on to the planning.
Yeah, that's okay. I just want to read to Helen and perhaps send to her something that she could use to hold Deloitte's feet to the fire. So it says, Deloitte are the pension fund and RWBM's auditors and have advised that there are no further material changes required to the pension fund annual report for 2021-22. That's what it says in the last minutes of the Berkshire Pension Fund committee report. So I think if you haven't seen that, I might send you the link. And then perhaps, as I say, you can hold their feet to the fire a little bit and find out why they aren't issuing a new letter, given what they said in their public meetings.
That link would be very helpful, thank you, because we can use it in the meeting that we have with them next week and ask that very specific question. So thank you for that. That is helpful.
Okay, thanks, Helen. Okay, thank you for that. We will, of course, come back to this next month at our next meeting. If we could move on to the planning report, if you'd like to briefly introduce that, Helen. Obviously, we have all read it, so a brief introduction only, please. Thank you.
So, as you say, you have all read it. The committee has previously seen an outline plan as well. So this is our more formal plan, but I think it's fair that I point out now that we need to recognise that it could change on receipt of both a full updated set of draft financial statements for 21-22 and also completing our work for 2021. Did just want to draw attention to the team before I ask Hannah to just run you through at a high level the key risks. 21-22 is my last year that I can be the auditor for Wokingham Borough Council under PSAA's under the rotation requirements. And obviously that then leaves 1 year between EY completing the audits and before the audits are handed over to KPMG under the new PSAA contract. So to manage this, we've put in a place where there's effectively going to be two partners on the audit. I will largely run 21-22, but the signing partner will be Janet Dawson, and she will then sign 22-23, working with Hannah on that audit. And we think that's the easiest way to transition when there's a sort of required rotation in the middle. So it's not ideal, but it is, we think, think, the most pragmatic way of seeing through this work to the point where we can hand over the audits to the incoming auditor. We will ensure that we introduce Janet to you at the next possible opportunity. So that's the one point I just wanted to make. And then Hannah, if you could just briefly summarise some of the key points that we would want to draw the committee's attention to, that'd be helpful. Thank you.
Yes, thank you, Chair. So I just wanted to take you through a very kind of high level, the risks that we've identified for the audit. The high level overview is set out on pages 6 to 9 of our report. That's 20 to 23 of your pack. And I'll just say very quickly run through these with you. So the significant risks and fraud risks that we've identified for the audit are the misstatement due to fraud and error or management override, which we identify on all audits, and there's no change in that from the prior year. And we focused our risk of fraud and revenue recognition through thinking it's most likely to apply to your financial statements through inappropriate capitalisation of revenue. That's mainly through capital additions to property, plant and equipment and investment property, or potentially incorrect classification of expenditure as revenue expended from capital under statute, as there's an incentive to reduce expenditure which is funded from council tax. In addition to that, we have identified the valuation of land and buildings in both property, plant and equipment and investment properties as a significant risk. This is because these represent significant balances to your accounts and are subject to valuation changes and impairment reviews, and they are under a high degree of material judgmental inputs to be able to generate the valuations. Then we've identified a number of areas that we class as areas of audit focus, so not as significant as a significant risk, but still an area that we would want to make sure that we pay due attention. These are the pension liability valuation. Again, this is a very significant balance in your financial statements, and you have to make extensive disclosures based on information from the actuaries, and there's a high degree of estimation involved in that process. And similar to 2021, we highlight the potential risk of further delays in receiving the pension fund assurances, but we will be engaging with the pension fund auditors throughout the process to ensure that we mitigate that risk as much as we possibly can. We've also identified going concern as a area of audit focus. That's no change from the prior year, but due to the new guidance that came in a few years ago, there is a heightened focus on going concern across all entities. The other areas are accounting for public finance initiatives, so PFI. Again, there is a risk that the council could fail to account properly for the PFI contract. We understand there are no significant changes from the prior year, so we're not expecting this to be an area of issue. We've also identified group accounting as a higher inherent risk. There have been some changes to the group structure during the 21-22 financial year. We need to ensure that those have all been accounted for appropriately, and that the accounting, the consolidation of the financial statements has been performed correctly. Our final area is around cash and cash equivalents. The council has a number of impressed bank accounts within its portfolio that are not reconciled on a regular basis, and reconciliation differences have been identified over the past 2 years when we have looked at these accounts. The next area I'd just like to touch on is our approach for the audit of the groups. This is detailed on pages 13, 32 and 33 of our report. That's 27, 46 and 47 in your pack. There's no change from the prior year in terms of how we are intending to obtain our assurance over the group entities, and we have been liaising with the component auditors to review their work in April, so that will be performed in advance of our year-end main audit work. Finally, I'd like to draw your attention to something around materiality. Our materiality is detailed on page 28, that we're reducing our level of tolerable error. So the calculation of our overall materiality level has stayed the same. However, due to the number of misstatements and issues we've identified during the 2021 audit, which we understand have not been brought to your attention in detail yet, we feel that we must reduce our tolerable error level to 50%. This is a reduction from 75% in the prior year. We will report back to the committee and bring this back to your attention at the next committee once you've had a chance to look at the misstatements that we've identified throughout the prior year audit. But due to their nature, we are required to reduce that tolerable error level. The impact of this will be that our sample sizes are likely to be bigger, and we are likely to require to do a little bit more testing than we have done in prior years. And we've already had that discussion with officers so they can be prepared and be aware in advance of the audit. I said finally before, but one final point is just to draw your attention to the timetable that is on page 38 or page 52 of your pack. Just to highlight that we have already started our audit planning. We have agreed with officers that we will be selecting samples during February to give them a good chance to obtain all of the evidence that we will need for those early samples in advance of the audit, which is planned to start in July 2023. I'll stop there, but happy to take any questions if you have someone on report.
Thank you for that introduction, Hannah. Members, any questions or comments? Yeah, Mike?
Thank you for the very comprehensive planning document. I thought it summarised things very well. I've got really a couple of points for management. I noticed one of the risks you've got going concern, and I just wanted to check whether management will present their going concern assessment and cash flows to the Audit Committee. Otherwise, I'm not sure we can review the financial statements appropriately. Secondly, really following up the point on bank accounts not being reconciled, whether those are being reconciled now. That's another question for management. And whether management can comment on these misstatements. Seems they must be significant if the audit sample size is increasing by 50%. Thank you.
Thanks. I don't know if Graham, you could start with that one.
I can, thank you, Chair. So in terms of the reconciliations, my understanding is they're now up to date and being undertaken on a regular basis. In terms of the adjustments affecting the level of checking, our view is whilst we would accept the number of differences has been large and we understand how that works, the actual material nature of the value and the outcome of those we don't believe has had a significant effect on the overall accounts or our balance or anything like that. But we understand the way the audit works is down to those number of errors and therefore that level of checking needs to increase. So we obviously accept that, bit disappointed that's the position, but understand that's how it works. I think we've made comment to the Audit Committee before around investment in the finance team over the last year and that team now being in place to improve that. So we're also very confident that whilst the level of checking obviously increases the opportunity to find anything, that actually we're in a much better place to actually ensure that our accounts are accurate and nothing's found going forward. In terms of the going concern and the cash flow statements, I don't believe, maybe Mark could help us in terms of whether the level of detail we provide to committee.
In terms of the going concern, we do a statement within our accounting policy around going concerns that sets out some of the reviews and findings we have undertaken from our side. But I think the key bit around going concern is we provide a lot of information to EY as part of their going concern review, and that includes a detailed cash flow that is for 12 months in the future from the date we expect to sign the accounts. So I don't know if Helen wants to add to that.
I just wondered if it might be worth adding for Mike's benefit, in that I'm aware that in particularly talking to my corporate colleagues, that I think it is relatively routine in their audits that the audit committee would see a going concern assessment paper, and potentially the workings behind that, including the cash flow. I would say it is relatively unusual in my experience to see that in the public sector, and particularly in local government. I've seen it more in our NHS audits and some of our NAO audits, I think, rather than in local government. And I think that's been, if we go back in time a little bit, really until the auditing standard was updated, in general in local government, both councils and, probably in fairness, auditors relied on the principle of continuation of service, and so local authorities are going concern until effectively DLUC tells them they're not. But notwithstanding all of that, good practice for audit committees in general, and I'm talking about sort of public and private sector, it would be, it is not a bad thing to do, in the same way that it is not a bad thing to take your accounting policies for approval at the start of the year rather than waiting till the end of the year. That's not a criticism of anything that has gone on here, but I just thought it might be helpful because I think, Mike, you might be coming at it from more of your background.
Yes, I understand it's one of the auditing standards now. Generally, finance and audit committees will sign off on, in effect, or be presented with a going concern paper.
I suspect that's one for the committee to consider, along with officers, chair, as to what you want to do. As I said, it's not something I see routinely in local government, but I have seen it in other sectors in the public sector, and I know it happens in the private sector.
Yeah, thank you. I'm also used to seeing it in other sectors, but perhaps that's something I can take forward with officers as to whether either it's distributed to members offline or it can come to the meeting, but I'll take that forward.
I think also, Rachel, the fact that it's been pulled out as an audit risk to us. So I think it really requires our follow-up.
Okay, thank you. Yeah, just on that, while we're talking about going concern, can I just ask Helen why there's been no change to the risk on going concern, given the change in the national picture over the last year?
I think, Chair, that's a very good question, but I think it comes back to the point that I made just now, in that still very largely the presumption for local authorities is that you are a going concern, because the services, there's the practice note 10 that is issued by the Financial Reporting Council is what governs the consideration of going concern for all public sector bodies, from government departments down. And that effectively says that if services are going to continue, so continuation of service provision, then the entity is a going concern, and it's rare that you would not be. So we're not really in a scenario where we would be concluding emphasis of matter or material uncertainty around going concern. Our focus is very much on the disclosures. So hence, that's why the risk has largely stayed the same. However, I think for those councils, and I'm aware of the item you've got later on the paper, that are in more financial difficulty, the work that we will do would increase, and our focus on the level of disclosure would increase, and that might increase the level of risk associated with it. I hope that helps.
Yeah, okay, thank you. Tahir.
Just a quick question on the value for money. You said that the Code of Audit Practice we are required to consider the council has put in place proper arrangements to secure the 3 years on this use of resources. I was just wondering, do you just give an opinion, or is there a kind of a KPI which we can see over the years and see how the council is becoming more economical and efficient over that period of time?
I don't know, Hannah, if you want to pick that up as our VFM expert in the firm.
Yeah, so under the previous code, we gave an opinion. We under the current Code of Audit Practice, we report by exception on value for money. So we don't give you a rating as such. We just highlight if we have identified any areas that we think there are significant weaknesses in your arrangements. The focus of the value for money under the new Code of Audit Practice is on the arrangements that the council has in place, rather than the outcomes of those arrangements. We would consider the outcomes in terms of, does that give an indication that maybe there's a weakness in your arrangements, but it doesn't go to the level of detail that I think that could be read into the wording of the guidance.
Okay, thank you. Any more points? Okay, Maria?
Yeah, I have some concern over the state of the economy and political movements at national level, and the degree of exposure we've got to our subsidiaries. It's not clear to me what the governance regime is. We certainly don't consider it here. And on the previous, on the recent course that we went on, it was quite clear that there should be some governance, some oversight by the Audit Committee of the governance arrangements of those subsidiaries, and we don't see that. Specifically, there's proposed changes in adult care services in the UK, and we don't know when those are going to come in because it keeps getting pushed back. But also there's some turbulence in the housing market. And I'm concerned about our level of exposure with capital loans to our subsidiaries, whether it be Optalis or the housing subsidiaries, and the underlying assets of those businesses. It doesn't give me any great comfort that these are audited not by our main auditor. And I just wanted a view on that, about how robust we think that our governance of these organisations is, and whether in fact they should be audited by our auditor rather than other auditors. I can't see any reason for them to be audited by different auditors personally. Thank you.
I'm going to defer to officers, I think, to respond to that question, because I think it falls more within the governance of that than perhaps our audit as things stand.
Do you want me to start? Oh, Graham, you were about to speak, I'm sure.
No, I would. I'd welcome you starting, Graham.
I was going to say, I'm sure you give a better answer than me. Okay, yeah, I think it's a good point. The scrutiny and oversight of our companies, and the housing and Optus are very different. There is no capital investment in Optus whatsoever. It's just a service provision, but the reverse is true. Housing clearly does have a lot of capital investment. So I think it's something on the more broader principle. I think is it in the audit plan? It is in the audit plan, internal audit plan. So that's one view in. So maybe we can pick up the governance understanding through that. As to whether we use Hazelwood's, I think is that's it, Hazelwood's and Haslers, yeah, or EY. I think, and obviously I'm not going to disclose it, but it was a value for money considering in terms of cost versus because they're relatively small and therefore would lend themselves to smaller outfits at much reduced prices. But there's no reason why we couldn't revisit that. I certainly would welcome the consistency of just having one auditor overall, but also it's not. It's down to the companies to appoint their own auditors, so it would be something we'd have to negotiate through the boards. It's not something I could just tell them they have to do.
Who's the shareholders? Aren't we the shareholders? The shareholders appoint the auditors.
Yeah, but this comes down to the governance. So although we're the shareholders, that doesn't mean you or I can instruct them. We have
I think we can. We're the shareholders. We appoint the auditors.
No, I mean
it's unacceptable that we can't. Not the audit committee, but the council should be instructing the auditors as the shareholders.
No, I meant you and I, or you or I as individuals. I meant the council, of course, is the 100% shareholder of the housing companies, but isn't. Well, it's only a 50% shareholder in Optilis. And the way we would have to transact it would be through the holding company, and the holding company could therefore direct the subsidiary about how that was undertaken. So what I'm saying is not a direct line. We would have to do it through the holding company. In terms of Optilis, that would be more complex because we are only a 50% shareholder.
Just picking that point up, Graham, I mean, we shouldn't be consolidating in the group accounts if we haven't got significant influence. And I think one of those indicators of significant influence would be appointing the auditors, just as a general point.
Without doubt, but I was just laying out the route that would have to be enacted.
Okay, thank you.
Understood.
Would like to move on if possible. Are there any other points on the audit plan? We've got Helen and Hannah with us. No? All right, well, thank you very much for that, Hannah and Helen. I'd like to move on to the next item now then, which is the risk register. So pleased to welcome Graham Ebers with us this evening, particularly to come to talk about something we wanted a bit more assurance on, which was the safety valve work and children's services. I think we've also got some representatives regarding the website item as well. Andrew, did you want to briefly introduce this item?
Yeah, just very briefly, Chair, before I hand over to Graham. So this is your usual quarterly update, although it is only 2 months since you last looked at the corporate risk register. So there's been relatively few changes. I guess the key thing to just bring to your attention is we've got one new risk at risk number 20, which is the website replacement project, which the committee asked us to look at your last meeting, and that's why Jackie and Sarah are on the call if you've got any particular questions that you'd like to pose to them around that particular issue. But really this evening it's for Graham to sort of talk through the risks from his perspective, both as a key member of the corporate leadership team, but also as Chief Financial Officer. And as you see in the report, we've got one of our top risks remains budget and financial resilience. So I'll leave it there, Chair, and hand over to Graham.
Thanks, Andrew. The summary report does point out that the Director of Children's Services will be present to report, but I have spoken to Helen and she's keen to come here and come back and speak to you. But I think, especially given the particular sensitivities of where we are in the safety valve bidding process, it's probably better to get my higher level explanation rather than anything more detailed that it wouldn't be wise to disclose at this stage. The report's set out in the usual way. As Andrew said, there was a new entry, and the summary on page 77 shows that in the main, risks have reduced in terms of their position on the grid, with one notable exception around cybersecurity. The explanations of the movements are included in the particular template. I'm happy to speak to all risks, including the one in children's services. Obviously, there's only so much detail I will be able to go in if it's, for example, in highways planning or what have you, but I will give you my best account as a member of CLT where we collectively discuss such things.
Very much, Graham. Right, open it up to members. Who's got any questions or comments? Yeah, Maria?
Yeah, I'd like to ask you about the safety valve, and I have to say I'm disappointed that Councillor Bray couldn't be here this evening because it was in the minutes that we would like her to turn up. She is the lead councillor on children's services, so I would like your summary of the way you see the safety valve rescuing us, I guess, because it was discussed in the last meeting that if this doesn't happen, then this is a massive risk for this council. So can you summarise your perspective on the risk at the moment and how likely it is that our involvement in the safety valve programme will get us out of that?
Thank you. Thanks, Chair. I can't speak on behalf of Prue, but I'm sure Prue would be keen to come along with Helen when they're able to, following the conclusion of the status of our submission, being whether we get brought formally into the safety valve programme or not. What I can tell you is that the DSG for the last, say, 3 or 4 years, dedicated schools grant has been growing at an increasingly alarming rate. So it used to break even, and then it moved to about 500,000 in-year deficit. Then that escalated to 1.5 million in year. Then that escalated to 3 million in year, and this year is looking like it's going to be an additional 6 million. That means that the dedicated schools grant would have a £16 million accumulated deficit at the end of this year, which is extremely alarming. And it started that trajectory following change in regulation about how the money could be used within the dedicated school grant, also about extending special education needs up to 25, I believe. But there was an extension of the age limits, as well as changes in the flexibilities about how money could be moved around. Anyway, that kind of began quite a number of areas. Authorities who always used to be able to break even within a 3-year period, started to move to an uncontained position. Under the safety valve, and this was a really helpful exercise, we are required to project forward 5 years beyond. And that was based on evidence around our own evidence and evidence around surrounding areas, etc., about trends and projections. And if we had left this unchecked, this was heading towards, say, in the region of a £90 million type deficit. And although there's, and still is, and remains for a couple more years, a statutory override, which has the effect of putting a ring around the DSG and protecting it from all the rest of the accounts, that statutory override would not be there forever. It is an override in terms of the statute. It is just a temporary solution. So my view from a CFO perspective is, based on that escalating deficit and the fact that ultimately this sits on our balance sheet and that statutory override will not be there forever, we were starting to be in a position of sleepwalking to a potential unviable financial position. So I was absolutely delighted that we have become part of this programme. And I'll be honest with you, whether we are successful or not in terms of the financial support, the rigour, the process, the profile and the investment would not have happened without being under the spotlight of the safety valve. And this is a very complex area. So it's around EHCPs, education, health and care plans. Once one begins the journey through a certain process of EHCP, it's very difficult to pull back. It then goes into a very statutory process, and very often, even if we try to contest, it doesn't find in our favour in the courts. So the key to all this, or some of the keys to this, are having the support wrap around to be able to help better solutions at earlier points in time. So early intervention, prevention type measures, which requires investment. It's also around having a higher level of self-sufficiency. We aren't blessed with huge number of places in terms of dealing with special needs. Therefore, we've had to go out of borough a lot, which is always higher cost and not a great experience, obviously, for the individual who has to travel further afield from their community. So it's got a really strong value for money governance, early intervention, prevention, looking at where we can step down in terms of the need no longer needs that level of, and also preventing from coming into the system. So all the things you would expect in systems management. And it also has a massive reliance on partners. We are only one partner in this. Obviously, health, schools massively play a huge part in this. And also, as best we can, trying to work with the parents as well, who may, if they didn't understand or better alternatives, may think that's the best route always to go down that statutory route. So it is extremely complex, involves lots of partners, and I would say the safety valve gives me great confidence because we have worked, it forces the organisation together. So through lead member of Children's Services, with Chief Executive, with myself, as both acting as Deputy Chief Executive and Chief Finance Officer, and Helen, DCS, and then obviously finance and all the plethora of staff in Children's Services. And it really forces a rigour around data, intervention, actions, ownership and delivery that I think we would have struggled to get to. So I feel massively more heartened and confident, having gone through that process over the last 5-6 months, that we will arrest that escalation. And yet also we need to keep at it. But I think we have a lot of the know-how and the investment and the belief and the capability to do it. And what I would say is it will be great if we were successful, because that comes with some financial support, but that is not the be-all and end-all. Sorry, that was a long answer.
Thank you for that. Before I go to Maria, can I just check in terms of my understanding? So on page 73, it talks about some of the numbers. So it says we've got a current deficit of 10 million, rising to 40 million in 5 years, but excluding the safety valve mitigations, that would be 90 or 100, as you were saying. So, but then further on, it says the safety valve programme aims to balance the budget. So the mitigations that have already happened, those are sort of things that we've done preemptive almost, while we're waiting to see if we actually fully accepted into the programme. Is that how it's like? I'm struggling to reconcile the balanced budget with the 40 million deficit, if you see what I mean.
Yeah, you're absolutely right. So unchecked, no mitigation escalates to that 90 million territory. with the mitigations, which themselves cost money as well, but counting all that in, the bits that are charged to DSG, all that mitigation work means that the accumulated deficit reduces from 90 to 40. So that's right. And it means in year 6, we would have, and this is the requirement under safety valve, we would have a balanced budget, as in there is no more addition to the deficit. So we balance in year 6, but in year 6, when we balance, the deficit after mitigation is 40 million, accumulated deficit after mitigation is 40 million pounds and gets no higher.
Okay, so as I understand it, and I'm going to press you on this, that if we're not successful in this safety valve programme, we have to write off this deficit of our own accord. And what you're telling me is that the deficit is going to be 40 million. And if we don't get the funding from DFE, it's no longer ring-fenced to something we can ignore. It's something that might affect our general fund levels. And nothing you told me so far has given me any confidence that it's a definite outcome with the safety valve. And if it isn't, the fact that we can't absorb 40 million because we don't have 40 million pounds worth of general reserves, that means that this council will therefore be unsustainable. So if you can tell me now that 40 million, if we don't get through the safety valve reserve, isn't going to hit the general fund, I will be happy. If not, this is a massive risk as far as I can see.
Okay, I can probably tell you the other way is I would expect by year 6 that ring fence, that statutory override would not be in place, and I believe it will therefore lose that protection that it currently has from the council taxpayer. I do not know how that would flow into the requirement to charge it against general fund. I don't know that. What
Did an overview and scrutiny as a big hit to the general fund? Has that now changed?
No, what I'm saying is that and I'm conscious I've only answered part of your question because there was another important part, but what I'm saying is at the moment, the statutory override prevents us being able to charge that to general fund. So it protects the council taxpayer. The minute that statutory override disappears, it clearly will sit on our balance sheet, but I don't know what our requirements will be in terms of how quickly you have to recover that or what have you, because it will sit amongst many other balances. But it is a big issue and it is of concern. But going to probably your primary point about this 40 million gives you no confidence. Our financial plans presented to overview and scrutiny show that each of the next 3 years, 1% year 1 plus another 1% year 2 plus another 1% year 3 of council tax will go into an equalisation fund, which will be there to both pay for the mitigations that aren't charged to the DSG and form a fund to be able to contribute to the deficit. The safety valve programme requires 6, so that to happen for 6 years. So in year 6, we'll have 6% of the council tax through 1% of each of those years will be contributing to the equalisation fund. I feel massively reassured knowing that that plan of recovery is in place, and because that's a significant amount of money each year, and therefore even at the end of year 6 we'll be able to accommodate, having funded mitigation actions, will be able to accommodate at least half of that deficit. And then, of course, you've got next year's and next year's and next year's because it's in the base. So I think that's quite a financially viable position and reassures me considerably.
Okay, thank you for that. I think it's an issue we'll want to follow closely. So if we can keep the request on that Helen and perhaps Prue as well can attend once we know more about the status of that. Okay, any other points from members? Okay, got Mike and then Tahir.
Thank you. There's a question really about the website replacement, which is a new risk. The report is a bit vague in talking about months when things will be delivered. May for user testing and July for the cessation of the existing technology. Given we are a few weeks away, I would rather see a little bit more information than just a month, because I don't know whether it's user testing will start at the end of May and the equipment goes out of, or the technology we're using stops on the 1st of July. That's only a month. Or is it 3 months?
I'm delighted to see two of my colleagues who appeared on screen who will give you a comprehensive answer, I'm sure.
Thanks, Graham. Sarah, did you just want to explain some of the timelines?
Yeah, of course I can.
Thank you. Thank you.
So, really great question. So at the moment, we've moved into the design phase. So we've done all of the research that we needed to do. We've created concepts based on that research. And so now we're moving solidly into the design phase, followed by development and delivery. So for the next 3 months, we're going to be actually looking at building the content into the website. So we've got to migrate everything, or all of the useful content, off of the current platform and bring it onto the new platform. So we've built in about 3 months for that. What we also have is we're working on a contingency whereby we will have we're planning on getting another instance of the website. So that would be there as a kind of backup. So we're looking at that build for that is kind of end of February. So we're looking to test the concept, hopefully mid-March on that one. So we've got contingency in place for that. And the team are currently just in the design and development phase at the moment.
So just to be specific, when does the user testing start?
So we've done the majority of the user research and user testing, which was to begin the conceptualization of what we were looking for. And then once we get something ready for delivery we're probably looking about May, June time, we can then do some additional user testing. We did do some quite comprehensive testing just prior, probably, I think it was just before or just after Christmas, where I think we got around 300 respondents who came back after doing some tree testing for us, and they helped us map out several of the key user journeys. So we've done that and used that to build the architecture of the site.
Sorry if I'm pushing this. The report, the risk says delivery of the beta version of the website in May. Is that the beginning of May or the end of May?
So at the moment we're looking at April, May. So we would aim kind of beginning mid-May, depending on how the content load goes. So what we need to ensure is that we bring across all of the high priority content that's necessary for the council to run. So we're looking beginning mid-May, but that beta version is going to be used then for that website testing. But at this moment, we don't know what that looks like yet, because we're still in the development phase. We don't have a CMS that we can actually build any content onto at this point. So it could be that the team find they can build 7 pages a day, or it could be alternatively that they can only build 3 pages a day. So we're just building contingency into that at the moment to see where it will bring us out in May.
Okay, thank you.
No problem.
I have questions on the same thing, really. So not as many. I have a lot of experience of delivering IT projects, and I've only ever delivered one on time. And that's in all the companies for all the projects. You say that you're looking at the low-level design. Has that been signed off? Is this work being done internally or externally? And if it's being done externally, in the contract, is there anything to say that they have to deliver it on time? Because I've been there before with external companies, and things can get very hazy.
Oh, absolutely. So we are working with an external company to support the work that we're doing. In terms of design, we are looking to sign off the designs. So we've signed off the concept and design for the homepage. We're just looking by the 14th of February, we aim to get the additional templates signed off in terms of what they're going to look like so they can move into build. On top of the corporate website, obviously, we're also building a number of microsites. So we've got the countryside parks one. So they also have different templates, designs and builds. In terms of how we're working with the supplier, which is called Zucha, they're fully aware of the tight timeframes that we have and how key it is for us to meet them. Whether there's a specific clause in the contract, I would have to go back and check that for you. But yeah, it's touch wood, everything is going really well. Like yourself, I've worked on many website delivery projects, some taking a lot longer than others, but this one I'm fairly confident that because we're going forward with this agile approach and looking to deliver a minimum viable product rather than saying, right, we need to bring everything across and everything needs to do X, Y, and Z, we're confident that we're going to go live with something that causes the minimum amount of disruption both to the council and to our customers.
Just to back Sarah up on that as well, to add, there is absolutely robust governance around this. So we're having daily stand-ups, weekly catch-ups, programme board meetings, and all of this gets fed back up to CLT, and obviously a regular review of the risks and then mitigating actions as we go. So just to give you some reassurance, there is a robust governance process around this to make sure that we actually do hit the milestones on time.
So is it being built pre-production? Is that being built in our servers or their servers?
So they're going to be hosting, I believe, originally they're hosting. We are building our contingency version on our servers because obviously one of the key reasons that we are having to hit this time turnaround is because our incumbent suppliers no longer going to be hosting the website. And this is why we're bringing in our contingency version onto our servers, and then Zucha will be hosting on theirs.
Thank you.
No problem.
Thank you. It's great to see that 5 of the risks are coming down, their risk profile, so that's very good news. At the last meeting, I think we talked about that, I think in most, all but one, the current risk is higher than the target risk. I see that a lot of the mitigating actions are in the next 6 months. If we carry on those mitigating actions, does it mean the risk becomes target in effect?
Yeah, that's certainly the plan. And I think I said at the last meeting that I think in terms of our maturity of our risk management approach, I think we probably do need to get better at making that much clearer connection between current risk, the target risk, and the gap between them being addressed through the mitigating actions. But I think, yeah, certainly that's the plan. And I think if you look at our risk registers a couple of years ago, you wouldn't see any connection at all. I think the individual risks now are better connected in the sense that you've just described there, Mike.
Thank you, Andrew. Thank you.
Thank you. And then just to comment on a couple of the movements that Mike had highlighted. So the climate emergency delivery risk has decreased. Now, we're still very unlikely to meet our aim for a carbon neutral borough by 2030. So surely that risk should still be high because we're still very unlikely to meet that. Also, on a similar point, The elections one has decreased. Obviously, that issue hasn't gone away, so I'm just interested in why that risk level has gone down.
Okay, thank you, Chair. On the climate emergency one, we talked about this at some length at CLT. I think previously the scoring was kind of taken in more of a planetary perspective and the enormity of that, and therefore we were an awful long way from where we needed to be. The positive movement on that is, and it's should be clarified in the text, it's about delivery against our own plans, which is the Climate Emergency Action Plan, and the Climate Emergency Declaration was along the lines of to do all that could be done to achieve that, and the manifestation of that is the Climate Emergency Action Plan, and therefore it was really saying we're no longer saying that level of risks exists against the delivery of our set out plan, but it's not saying that it's all easy and will be delivered.
So it comes down to what our actual objective is that we're measuring the risk against. That's the objective, to be carbon neutral, or it's the objective to deliver our plan, which doesn't result in carbon neutrality, but we are still delivering on that plan. So
it comes down to our more local role in the climate emergency agenda, as opposed to considering climate emergency as a global issue.
Just to come back on that, I mean, I think that the plan always did look at what we were responsible for as a council and what was within our remit. It wasn't a global plan. But
no.
The fact is that that plan does not result, even if we do everything in the plan, it doesn't result in us being carbon neutral. So it comes down to what our aim is. And you said at the beginning of your statement there that we would always do everything that we could to. So it doesn't come down to think what is the objective that we're using the risk register to kind of measure against.
I think it's about, yes, that climate emergency declaration, of which, of course, the Climate Emergency Action Plan is a significant part of, and obviously will be developed and evolved. I think what I was trying to say is we're in the mind's eye of assessing the risk. Previously, it was kind of taking a global perspective, and therefore, when one takes the more local perspective, it becomes slightly more deliverable, manageable, achievable.
And Chair, just on the elections risk, so what I would say is that the elections risk is still significant. That's why it's still on the corporate risk register. Some mitigations have taken place since we last met in November. So, for example, we've had some modest funding from central government to support the implementation of this. The Electoral Commission have provided more guidance about the implementation and how we manage that. The Electoral Commission have also launched a national campaign in January to raise awareness of the voter ID requirements, and also the government has launched its voter certificate process for those people who don't have access to the required forms of ID. So, yeah, I wouldn't want to give the committee the impression that risk has gone away by any means, because that's certainly not the case. And there is a lot of work and a lot of further mitigation that we need to do between now and the 4th of May to mitigate down that risk even further.
Okay, thank you very much. Any more points on the risk register from anyone? No? Okay, thank you very much, and thank you to the officers contributing on the website as well. Okay, so the next item is the Audit Committee effectiveness. I want to spend a reasonable amount of time on this one. I'm pleased at the work that's been done in conjunction with officers on this item. So there's a lot of time been spent, as you'll see in the reports, analysing the effectiveness of the committee against SIP for best practice, and some work on the terms of reference as well. So I want us to be able to honestly appraise our effectiveness, look at what we've done well, look at where we can improve. So just looking through the report, then you'll see that it includes the improvement points that the committee raised last year, and a couple of wins on that. As obviously, I'm very pleased we've got our independent member sitting with us now, which is great. And also, we've had some really good quality training, which was another action from last year. And then looking at the rest of the report, we've got sort of three main sections that I want to look at. So one is the assessment that's been done overall of the committee. So that's been done by officers. So we need to have a look at it and say, do we think that's fair? So that's summarised on page 107 of the pack. Then I want to look at the actions that have been suggested. That's summarised on page 118 of the pack. So are they the right actions? Are there any other actions that we should have in there? And thirdly, I want to have a look at the terms of reference, whether we agree with those changes and approve that as a committee. Andrew, anything else to add before we get into all of that?
No, I think that's a really good summary, Chair.
Great. Right then. So first of all, if we can look at the assessment overall, do members have any comments on that assessment? Do we think that's a fair assessment? So page 107 is the kind of summary of that. It's obviously a subjective judgment, but do we have any comments? Do we think that's a fair assessment of our effectiveness as a committee? Yeah, Mike?
Only through my knowledge, Chair. I noticed the point we ticked ourselves requiring significant improvement in has the committee maintained its advisory role by not taking any decision making. Is that because the committee has been making decisions and shouldn't have done, or so really it's the scope of the committee?
So I took that to mean that, as came up at the SITFA session that we had, that we have been having items where we've approved things and decided on strategy type items which are not actually particularly appropriate for an audit committee to do. Presumably that's why it's been graded like that.
Yeah, if I could just add to that, I think we need to recognise that the latest SITFA guidance only came out in the autumn, so this isn't any criticism of what the committee has done in the past. It was like, to my knowledge, all local authority audit committees did sign off accounts, did approve treasury management strategies. So that it's not intended as a sort of criticism or a weakness of historic or current practice even, but it's recognising that the guidance has changed now, and it is about this committee, I would say perhaps being more like a scrutiny committee, so not being involved in decisions as such, but advising the decision makers, for example, the executive, in terms of the assurance environment that you're taking responsibility for and having oversight of.
Thank you. Any other points on the assessment overall? Okay, so if we move on, sorry, go on, Mike. Yeah.
We've been marked down on items 12 and 15 and 17, but I'm not sure what we're doing about it. I'm probably the weak link here because I'm probably the only member of the committee who doesn't have an accounting background.
Okay, so number 12 is whether we have met with external auditors and the head of internal audit. So that's something we can do, but we haven't chosen to do. So that's meeting privately without officers, just having access to them. And we've always been able to do that, but it's been marked like that, presumably because we just haven't taken up that opportunity. So that's something we can decide as a committee whether we want to have, say, 10 minutes at the beginning of every meeting or every other meeting where we just meet with internal audit or we just meet with external audit without the officers present. So that's something for us to decide whether we want to do, but we haven't done it to date. Sorry, what were the other ones that you mentioned? 12?
15.
Okay, I'm going to pass over to Andrew on those two terms of.
Well, again, I'd say the same as I said for the last point, that this isn't meant as a sort of criticism. I think the fact of the matter is that an evaluation of skills hasn't been done, and SITFA are saying it's good practice to do that reasonably regularly. Number 17.
It hasn't been done. How can you put any mark 17? If 15 hasn't been done, how can you mark 17?
Well, yeah, maybe that's an error on my. I see your point there. I think that. What SITFA are pointing to here is that there's more that the committee can do in terms of skills, training, how members actually get appointed onto the committee, and whether or not there's any sort of assessment done prior to that appointment at annual council. certainly, for example, if I use a sort of comparison with our appointment of our independent member in Mike, we did go through a more, what I might call a more sort of traditional selection process with, if you like, a job description and sort of key criteria that we were looking for. Now, I'm not saying we should replicate that, but I think CITFA is sort of indicating that it's an opportunity to think about the particular requirements and particular skills that individual committee members need, which is also really helpful in terms of informing the right sort of training that the committee needs moving forwards as well.
Yes, I've got a question on 21, and this is no criticism of you, Rachel. It's about our meetings well chaired, ensuring agenda items are addressed. Now, I remember about 2 years ago, you brought forward a document which suggested that the chair should be an independent member. I can't remember whether that's an independent councillor or an independent member of the committee. And I'm just wondering whether we should still consider that. One of the issues is that I don't think the independent members get a vote, which would complicate the issue. So I'm wondering whether you would still suggest that, because that was definitely one of your suggestions at the time.
Yeah, and I think when I raised it, it's probably the year before last now, I was saying it should be an opposition member. So they would still have a vote, but they wouldn't be part of the ruling group. Yeah. And I'd still say that would be good practice. So yeah, okay. Any other points on the assessment? Yeah, Maria?
Yeah, I'm a bit confused about the scores at the bottom. Because there's a nought in the major improvements, and we've definitely got 3. I think, is it 1, 2? Yeah, we've got 2. So, they're weighted at the top. Oh, I
see.
Get more
points for the further if you go.
Got it.
I'm glad you spotted that, Chair. I thought it was my bad arithmetic there, but I mean, I would just stress this is quite subjective, but it does just give a snapshot for the authority in terms of where you think you are.
Okay, Mike. Yeah.
With that in mind, then, I mean, it's obviously a public document because it's in this committee minutes notes, but it becomes a public document when it's agreed, presumably.
Well, it's a public document already in the sense of this document has been published as with the agenda for this meeting. Yeah. What I would say is obviously this is an opportunity for you to shape this further, to disagree with elements of the scores if you disagree with any of them.
I think for me as well, the main thing is to use this as a tool to say, right, what are our actions now coming out of it, rather than should that be a 1 or a 2? You know, it's a tool to move on to the next section. If that's okay, which we will now do. So page 118 is it pulls out the recommended actions coming out. So just to pick out a couple. So in terms of reference, obviously we're going to look at shortly. We've already mentioned the committee to meet privately with auditors, so that's something we can bring. It's already in there. And also we've got recruiting additional independent members. So this is new guidance. We've already got 1. And the guidance is that good practice is to have 2. So that's something else we need to sort of take a view on this evening. So any other comments on those actions? Are there any that are missing? Are there any that we don't agree with? Any other comments on the actions? Okay, if I'm not hearing any comments on those, we'll take those as being agreed then. And then lastly, if we could look at the terms of reference. So this starts on page 121. So this has been altered in the light of the new guidance and also the very useful session that we had with CITFA last year. So there's quite a few changes, but I think they're all really positive changes. So do members have any questions or comments on the changes suggested in the terms of reference?
Wondered whether there should be a paragraph on voting. You've already mentioned it today. You know, who can vote? I think we know it's the councillors, but it's not actually set out here. What happens if it's a draw? Does the chair have the casting vote? So probably be good practice to say something on that, I think.
Is that laid out anywhere else in the Constitution, or do we need to add that?
The point about the chair having the casting vote is elsewhere, but I think again it's a good point. I don't think there's any harm in terms of adding the clarity of voting, particularly for the independent members.
A couple. First of all, I didn't take the old version and compare. Is there any reason why some of the updates that seem to be additions are in red and some are blue, or should I just assume different editors?
It is different editors. Yeah,
great. I thought they all knew. The other thing as well is regarding the voting matters and the chair provided vote. I would actually suggest we don't include it in here, but include it as a reference as to where it can be found. The reason being, having the same information in two locations means one can get out of date because it doesn't get updated, but absolutely reference where it is because I think it's important we're clear.
Provided we know what it is. If it's to a document we don't have access, then it's not very helpful, but it is here.
It will be elsewhere in the council's constitution, so it would all be in one document. I should have said by means of introduction that this terms of reference, the current terms of reference, is in the council's constitution. It's section 4 of the constitution, so we're just amending what's already there. Yeah, I'll take that point away.
Yeah, I was looking for the omission of the Treasury Management Strategy, which we shouldn't be agreeing. That became clear. And I understand that should go to executive as a function. I was trying to look for it in here, but some bits were crossed out and some bits were in red and they weren't crossed out. And I did get a bit confused. So I'm assuming that we're not in future going to be agreeing as Treasury Management Strategy, which is a good idea as far as I'm concerned. I just want to ask about the agreement of the annual statement of accounts. So where will they go for oversight and agreement?
Okay, if I can start, and then Andrew, perhaps you can. So on the Treasury Management, page 124, you'll be able to see where it's striked out that the Treasury Management Strategy is no longer agreed by the committee.
Which one is that?
So,
124. Oh, there it is.
J.
Honestly, probably didn't overlook J.
And then in terms of the annual report, my understanding is that we've still come to Audit Committee. It's just that we aren't approving it. We're sort of scrutinising it, reviewing it, commenting on it. Would that be your answer?
Yeah, that's it, Chair, and also the Treasury Management Strategy. I think what this change would give is much more flexibility for the Audit Committee to decide what aspects of the council's operations you want to seek explicit assurance on. So, but I'd suggest both of those, the statement of accounts and the Treasury, you'd still want to look at them and maybe make recommendations to the decision-making body. But as I said earlier, you're carrying out much more of a scrutiny type role rather than a decision-making role.
Yeah, I'm not convinced about that for the Treasury Management Strategy and Policy. I think that should be agreed by the executive. I think that's what most people do. And I can't see what role we're going to have in looking at that. And I did read something somewhere recently, which is that the Audit Committee should look at the outturn against the Treasury Management Strategy quarterly. And I don't see how we can have those two things alongside. I think the decision-making or the setting up the policy should be in executive and then agreed by council, and then we should have a look at the outturn. I think that would be much more satisfactory. But as far as the accounts go, I think that's going to need a little bit more thinking. I'm not sure what the purpose is of bringing it here, other than to have a look at the audit report.
Okay, I can see Helen's got a hand up. I'll just come back on the Treasury Management stuff, and I think, if you argue we should look at Treasury Management outturn, then arguably we should also be looking at in-year revenue. We should also be looking at capital monitoring. So I think it's up to us to decide, well, is there a particular reason why we want to look at that, or a particular risk that we want to explore? But I don't anticipate them being standing items in our terms of reference. So I'll let you think about that for a moment. And then perhaps if I could just bring Helen in, as I suspect she's got some pearls of wisdom on the annual report for us.
I doubt they're pearls of wisdom. If I'm honest, I think I would welcome a conversation with either Andrew or yourself, Chair, about the approval of the annual accounts, because they have to be approved somewhere, and whoever approves the annual accounts, the statement of accounts, are those charged with governance. So if it is not the Audit Committee, then we don't bring our reports to the Audit Committee either. We have to report to those charged with governance, and those charged with governance are the people who approve the statement of accounts. So whilst I completely understand the logic of what you are doing, it is going against everything that we have done to date, and that is done at all other local authorities, aside from a handful where we have to report through the Audit Committee and then go to another committee where a statement of accounts is approved. That may be full council, or it might be something else, and that just adds another layer of complexity, and I'm not sure that that's been properly considered. I'm not sure it's for debate. It's a discussion for, I think, taking offline, perhaps, Chair, but I'm just nervous about what's being proposed right at the moment, because there doesn't appear to be a solution.
Okay, yeah, that's very clear. Thank you. Andrew, I don't know if you've got anything else you want to add on that.
Yeah, happy to take that away. All I'd say is that this is based on the sit for best practice from last autumn that quite clearly says it shouldn't be a function of the Audit Committee, but I think Helen's right. We need to be clear what the alternative, what the solution is if this committee isn't going to carry out that role in the future. Okay, we will take that away. Thank you. Any other points? Yeah, Mike, and then Mike.
Just one minor one. The last item, section paragraph 4.4.11, duration of meeting. Should that now just be aligned with what we do in full council about continuation? Or better still just refer to the amended constitution about the duration of a meeting?
It's not something I've considered explicitly. I don't think, from my memory, it's ever been an issue for this committee in terms of the length of meetings. But happy to take that away, Chair, if you'd like me to.
It's only picking up the same comment that David made earlier on about rather than having stuff in the constitution and stuff repeated in the term of reference, you change one, you're going to make sure you're going to change the other.
Okay, we will just check that and see if we would recommend a change on that. Thank you. And Mike?
If one of our roles is to provide technical assistance, advice, experience, then I would see that sort of as a role looking at the financial statements.
Okay, any other points on the terms of reference? Okay, Maria?
Yeah, just an observation that I'm going to find it difficult to agree to B, given what we've discussed about two significant things, which is the Treasury Management Strategy and Policy and the annual accounts and the other things we've discussed. So the recommendation, which recommending to council, we can't really recommend that at the moment. So before we get to the vote, can we have could you think about some exceptions?
I think that's really apart from those bits that we're going to check. Right. Yes, they've just come into the recommendations there. So recommendation 1 is reviewing and reviewing the assessment. And then recommendation 2A is second and then B. I do apologise. So just running through the recommendations. So Maria is putting up recommendation B, which is recommending the proposed constitutional changes. So I don't think we're ready to do B in full yet, but perhaps we could amend that wording so that we take all of it except those 2 points. Okay, so the 2 points being the point on the annual report, and then just those internal referencing points as to consistency with other committees. Is that the two that we've?
It was suggested that, I've forgotten where it was, that we do have something to do with the Treasury Management Strategy and Policy, but actually I'm quite happy for it to be taken out and for us just to look at the outturn unless there is a specific reason.
So at the moment that there is no the strategy is taken out. Yeah. And then it's up to us if we want to call for certain reports on particular things, as it is with anything actually. So that's not going to be a standing item in our forward plan, etc. But we obviously can ask for things if that's okay. All right. So if we move to the recommendations, if we could take them in turn then. So the first one is reviewing and agreeing the assessment. So we're all happy with the assessment as it stands. Can I just see a show of hands? Yeah. Okay, thank you. And then 2A, approving the recruitment and appointment of a second independent member. Can I see all those in favour of that? Yeah, thank you. And then 2B, do I need to provide the precise wording on this? Yes, I do. So recommending the constitutional changes to the terms of reference with the exception of the approval of the annual financial statements and checking of internal consistency with other areas of the Constitution. So with the exception of those two things, are we happy to recommend the remaining changes to the terms of reference as part of the Constitution? Okay, thank you very much. Good, thank you for that discussion. So moving on to the next item, which is section 114, lessons learned. So this is page 135 or thereabouts. Okay, can I ask Andrew to just introduce this?
Yes, just very briefly, Chair. So this is really about being a learning organisation, and CITFA produced this report last autumn for all local authorities to consider in terms of any particular actions that they needed to take to make sure that they could learn from those authorities that have found themselves in severe financial challenges. We've done that in this report, and there is a short action plan on page 135, and it does reference in that some of the things that you've talked about tonight. For example, the last item on Audit Committee effectiveness and doing that regularly. And it also talks about an item in there that is coming to your March meeting, which is around the CITFA Code of Financial Management and the self-assessment that's been done there and the internal audit assurance that is currently taking place against that self-assessment. So I think from my point of view, this is very much sort of in line with, for example, the LGA peer review that we had recently that gave us insights into areas that we can improve in. It's in no way sort of suggesting that this is a council that is like the councils in that CITFA report, but I say that within the context of the things that we've talked about this evening and corporate risk register, and clearly having good, strong financial management and control of our finances is our top risk to pay attention to. But that's my introduction, Chair, but happy to take questions, obviously, with Graham here as well.
Right. Thank you very much for that. Thanks for producing the report. It's a useful summary to go through all those challenges and assess where we are. So questions, comments from members? Oh, sorry, Graham, did you want to?
Yes, sorry, I was just going to follow up. It's all right, with a few comments. Yeah, I think the point of learning is really important. So these reports have been brought here voluntarily, which includes this one and the assessment against financial management best practice. So the request is to take them in the spirit of we want to try to both give you assurance, but also provoke thinking, discussion, or what have you about how we can improve our governance arrangements. What I will stress is even the table is a very summarised version of our response. It was just to get something together to talk about, and of course point to other documents and what have you. And I guess it's also worth pointing out that although we're here about councils in crisis and we think it's all about the money, it's worth looking at page 129. Okay, over-ambitious savings targets, not surprising. Lack of medium-term financial plan, again, not surprising. But leadership weakness inadequate governance is actually a very strong theme throughout councils that fail. Councils that fail from a governance perspective, but often manifest in a financial 114 notice or what have you. Then, of course, weak financial management and lack of reserves is probably speaking the blinding obvious again.
Okay, thank you for that. Questions, comments? Mike?
Yes, those themes will be very similar in the corporate sector, as we know as well, very common factors. I did notice on page 131 where we're talking about supporting the committee, some questions have been sort of posed that audit committees should ask. And in 2, it talks about scrutiny and challenge of budgets, financial reports, etc. And I wondered whether those are ever presented to the audit committee.
Currently, what's a bit of feedback? Oh, sorry. It's all right. Currently, and I believe constitutionally, the role of scrutinising our budget sits with overview and scrutiny. And that's quite a lengthy process that starts in the summer and ends about now. And we go through all the various components of the budget submissions, the capital, the revenue, both growth and savings. And that gets quite an airing and quite a bit of challenge. So I think that's probably, constitutionally that's the best place where it's left. But I think it's totally right for you as audit to know that's where the challenge goes on, because obviously your key role is to have assurances of good governance, even if you're not undertaking them directly yourself.
So maybe we need to just put a comment on the paper saying Wokingham has a different way of approaching this, and it's not, that scrutiny is not performed in the audit committee under the constitution.
Any other comments? Yeah, Maria and then Mike.
Yeah, you refer to SIPFA's Financial Resilience Index on page 135. Well, that was from 2019, and honestly, I think it should disappear from here because the world has moved on since then, and it's just not up to date. And they haven't done it since, I don't think.
Yeah, the SIPFA Resilience Index is updated every year. The reason why we start with that historical graph for 2 reasons. That was the first time the Resilience Index was undertaken. But also it was the only time that a comparison against all the local authorities was provided. It's really hard to do it. And it was actually the MJ that did it, and they published it, and they haven't published one since. So it's a little bit irksome, but all we can do, or it's good to have a comparator at least at one time, and then talk about what's happened since. And I'm pretty clear of the trajectory of movement since that time. And that's described to some extent in the CFO report as well. But I can tell you, for example, the last time we had the data from the SIPFA Resilience Index, every indicator moved in a positive way, with one exception of the HRA reserves, which moved downwards, and that was a deliberate choice in the context of what was considered to be a prudent HRA reserve, and it was considered that we could reduce that and still be prudent. But all the other indicators moved in a positive direction. But you're right, it's historical. It's not very well benchmarked. I'd love it to be. I'd love MD to produce that every year. But at least it's something, and gave me considerable assurance when it came out, and then of course gives me assurance if those indicators are improving from already a fairly strong base.
Yeah, but you don't actually know what anybody else's indicators are. It's fine if you say the SIPFA Resilience Index shows that we're pretty good, but not that we're in the top 20, because that's not something that we can say. And we shouldn't rely on something that's from 2019 in terms of ranking.
I was a bit concerned about questions 8 and 9 on page 137. Does the Audit Committee have sufficient oversight of the council-owned companies, and are the senior officer members involved that have the skills necessary? We don't know. The answer that it's included in the audit plan in 23-24 means we're probably not going to see it till late 24, if not even 25. But this committee doesn't actually have the answers to those questions at all.
No.
I'm not sure the answers are the right answers to the questions.
The answers are, says the situation at Wokingham and audit committee action.
Yes.
So in that context, they seem like they are, that is the position, is that they are included in. So audit committee will have oversight, they just haven't right now.
Not for a very long time.
I suppose, well, 23-24 isn't that far away.
I think the word is sufficient, isn't it? And it's not sufficient. It doesn't say, will it be sufficient in the future? It says, is it sufficient? And it's not. I mentioned this earlier in the meeting, and I'm still worried about the risks with council-owned companies when we have loads of loans to them and we don't see them.
Yeah, it's just we wasn't a yes or no response to the question. It was the situation at Wokingham against the question, which actually provokes a reinforcement of the debate we had earlier, is that it would be good to get oversight, which will come through on that plan.
Yeah, I mean, this is to identify areas where we can improve, and the audit committee can do something different if it needs different assurance. We've identified it. We've said, yes, it is in the internal audit plan. We can check in with Catherine and find out when it's happening and when we're likely to get that. If there are other areas of assurance that we want to request, of course, we can do that. The internal audit seems to me to be a good place to start on that. But if you've got other suggestions for what further assurance we could reasonably ask for, then please go ahead. Right.
I'm not sure it's an area for this committee, but I don't see any of the budgets or anything like that of the council-owned companies coming forward to any sort of scrutiny. Now, if you're going to loan a whole bunch of money to your subsidiaries, then there should be oversight. Effectively, those companies that flow through, it is our business. We provide adult social care and we build houses. We just happen to have a company structure in between. And I think those businesses should be subject to the same level of scrutiny as anything that we haven't offshored or outsourced, if you like, to a company. It's not sufficient what we're doing at the moment, in my view. And I don't see why we can't, for example, even if it's in a meeting that we have to have in part 2, we should be seeing some of that, perhaps not here, but overview and scrutiny. And I don't think we do that.
Yes, I think that's a good point. And previously we did report the company's performance to executive along with the budget monitoring. And we definitely intend to do that this year to at least provide a half year performance, and obviously with a forecast for year end. And that reminds me to double check where that is on the forward programme. But that was the intention to provide a half yearly and of course an end of year position as well.
Yeah, just picking up the point about the internal audit of companies. So Catherine will be bringing the 23-24 plan to this committee next month. So it's obviously quite legitimate for you to ask Catherine to fast track that audit, do that earlier on in the period, because you recognise or you've identified this as an area that you'd like to get that internal audit review on. And I suspect that audit then would give you a useful insight and set of recommendations for areas maybe of improvement around the company's governance or oversight of that could be set through that internal audit.
Okay, thank you for that. Any other comments on this section? No? Okay, well, thank you very much for putting that together. I've also got a really good summary that Catherine Hickman sent me that Grant Thornton had produced, it a similar sort of lessons learned report, so I'll circulate that to members as well, because that's also useful from a similar similar perspective. All right, then the last item we've got this evening, for the last time, potentially, is the Treasury strategy. So there have been some changes in format, etc., in risk as part of a request from this committee, which has been put through. Graham, are you going to be introducing this one?
Yes, thank you, Chair. So we're asking the committee to support the Treasury management strategy and recommend to the Council 3 areas: the potential indicators, the annual investment strategy, and the MRP policy. As you're all very aware, the strategy is key to both ensuring the Council has cash and cash flow to run its operations, but also to enable the delivery of the capital strategy. I'm sure you've read the report, but just one element I wanted to pick out particularly was the proposal to change the minimum credit rating, so to move it from high to upper medium. We've worked with Link experts, external experts on this. That rating is still one above what they would normally recommend in terms of safety. So we're still confident that's really a safe area to be, but it gives us more flexibility and allows us to manage our cash in a more robust way. Happy to obviously take any questions. Thank you, Chair.
Thank you. Could I just comment on that very point, actually, in terms of changing those credit ratings? I guess my question would be, why haven't we done that previously? Is it basically we've decided now we're happy to take a bit more risk on that because it gives us those additional benefits of the flexibility?
I'm not sure in terms of decisions prior to my time, to be honest. I suppose it's one of those things we continue to keep under wraps, under review. The ratings, as I understand it, in terms of the different organisations, can move between those two quite quickly. So my understanding, for instance, at the moment we use Nationwide and Skipton, and this would add NatWest, Lloyds and Barclays. So I'm not aware of anything particular that's meant that's not reasonable in the past. But as I say, I haven't been here to understand it, and this still feels like a very safe place for us to be, just giving us that bit more flexibility.
Okay, thank you. Comments, questions from members? Yeah, David, yeah?
Just specifically on that, you mentioned it gives you more flexibility, which I completely understand, and if this has been advised, I'm fine with that. But could you maybe give an example, hypothetical or otherwise, of an investment we might make that was in that upper medium grade that we obviously can't today?
Yeah, well, when we go, so obviously, as you'd imagine, we'll go and we'll be requesting, almost on a daily basis for shorter and longer term, depending on what we need at the time, certainty about money coming in and going out, going forward. So at the moment, we have a small number of organisations we can go to, and therefore the offers in terms of interest rate and which organisations are limited. This will widen that range, so there's a bigger number. So we might have 2 or 3, 4, 5 to choose from, whereas at the moment we may end up with one or not able to do the short-term investment that we want. So it wouldn't be for the way we invest money isn't for necessarily something particular. It's to overall manage our cash flow in the round. Does that answer your question?
Yeah.
Yes, thank you.
Okay, other comments, questions from members? Mike?
Thank you in the report for pulling out the list of loans and their maturity dates. I don't think we had that level of detail in the last meeting. It's quite interesting that 15 million, I think, matures in a couple of months' time. And I think if you've got to go out to the markets for that, I don't know, 4.5%, 5% you might be paying. So that's an extra £500,000 interest charge per annum. So I think that schedule is very useful for us to actually see. I'm sure involved in day-to-day management, you've got that head, but for us, that gives visibility that we haven't looked at before. And another just point, probably being a bit anal, or I don't understand the schedule, but on page 157, I was just looking at the general fund in the summary at the top of the sheet with the bottom of the sheet, and 23-24 agrees, but I couldn't really see how years 24-25 and 25-26 agreed. So you've got the general fund capital programme, for example, 24-25's 59.6, and in the analysis underneath you got 55.1, but maybe I'm misreading the schedules. 157.
Yeah, sure. Well, let's take that away, and let's just confirm that. Yeah, confirm that's.
As I say, a bit of an angle
Yeah,
point.
No, not at all. Not
proves
at all.
I read
Thank
it.
You.
Thank you.
Thank you.
Okay, other questions, Mike, and then Maria. Yeah.
It's probably related to the same thing, but on the top page 158, it says the general fund capital programme has an estimated shortfall of circa 28 million. I couldn't find that 28 million on the previous page anywhere. Or I'm being stupid.
I can just confirm that, Graham. I think it goes back to the previous point, actually, the table above that sets out the capital programme budget, and then the table that sets out how we're proposing to fund the capital programme. The difference between the two is the £28 million capital funding gap that we set out in the narrative below the table, the funding table, across the 3 years.
I thought that was the case, but I was trying to reconcile 197.7 million in the top table with the 183.5 million in the bottom table. The difference between the two and 28 million. I was looking at the final column, which says total, which presumably is the addition of the 3 years. We've got 197.7 halfway up the top half of the page. We've got 183.5 at the bottom. Difference in 28.
Yeah, we'll double check that.
Yeah.
And can confirm that.
It's quite a big difference, isn't it?
Yeah, we'll get something back quickly to members.
It's 13 versus 28. I want to lose 15 million, just like that.
Yeah, thanks for picking that one up. Okay, Maria, did you?
Yeah, sorry, I've been concerned about minimum revenue provision for some time, and in terms of Thurrock's statement, because I thought I'd look lessons learned, see what Thurrock was, what brought their downfall, if you like. I'm still concerned that our minimum revenue provision does not comply with the understanding of the current statutory guidance, which says that you should provide for all debt associated with investing, and we don't. I don't think we don't charge on the loan capital in WBC Holdings, which was one of the problems, I think, for Thurrock with some of its investments. And we only provide 10% of assets that can be disposed of for appreciation of maximum 15 years asset life. I still don't think this complies with the current code, which says you have to provide for everything. And Thurrock, when they reviewed their treasury management, they changed from what they had previously to providing for everything. I've already mentioned the loan capital in WBC Holdings. If you've got an underlying asset base and you don't actually know from year to year, or there's no visibility from year to year of the value of those assets, then you should be providing something, in my view. And in terms of the economic turmoil, 10% of a maximum 15 years asset life, so you're providing 0.67% over every year up to a maximum of 10%. That doesn't seem to me to be particularly prudent, given that the housing market is expected to drop. And possibly quite significantly. And I can't see how this complies with what we're supposed to do. Sorry, Graham.
So did you want to take?
Sorry.
Thank you, Chair. I'll Okay, I'll start. An MRP is an extremely both complex area, but also a very fluid area and still live in terms of its fluidity. First of all, just to correct the statement, and I know it appears in the Thurrock report, that it states that there's a statutory requirement to provide in the way that Councillor G described, and also referenced that it was retrospective as well to all years previously where it hadn't been provided. That is not true.
I did wonder about that bit.
Okay, yeah, and both bits aren't true. The current statutory provision sits under the Prudential Code, and the Prudential Code clearly states that it's about a prudent provision determined by the Section 151 officer. And indeed, the new Prudential Code that we will be enacting in April 23 and is reflected in the Treasury Management Strategy still states it's a prudential provision determined by the Section 151 officer. However, following some very alarming councils in financial crisis, and picking, say, the case of Thurrock, who I understand are borrowing of 1.3 billion and 655 million went into companies via bonds for schemes including a total of 53 solar farms. The reason why I'm saying that is this is the enormity of things that have gone on outside the council. And I think this context is important because our borrowing is substantially, so my biggest concern about changes about MRP, and I'll come to that in a minute, is around strategic development locations and us forward funding the infrastructure to unlock the development, and that's a very deliberate policy. And under the most extreme interpretation of what could happen, which Councillor G has alluded to, then I do not believe we could, under a new local plan, do that again. That would be far too costly. At the moment, we are simply carrying the costs of the funding in terms of we invest and then we get the SIL triggered in sections later down, and we carry the holding cost of capital, but we don't provide MRP because the money is going to come back in from SIL. If the regulations come in the way they were initially, the regulations come in the way that they were initially proffered to, then that would have had a significant impact on the council's housing delivery, strategic development locations, and indeed other forms of regeneration. Now, the reason why I say that is because when the consultation came out that talked about this very clear, there are no exceptions, you must do this, which is obviously a very big movement away from determined by the Section 151, obviously in the context of all. Then when that initially came out, that would have been extremely damaging for the council's key objectives. And the government, through the consultation process, which started over 2 years ago, were very clear quite early on that they did not want to generate unintended consequences, particularly around development, regeneration, housing provision, all those types of things. So over that 2 years plus, there's been 2 consultations. The last one ended in July, and there still hasn't been a new set of regulations and practices that have come out. Therefore, all the previous ones are the regulations. We just know that there was an intent to change. There has been 2 consultations. It's clearly complex. There's clearly a desire not to harm or curtail I believe, authorities like us that in the main have used borrowing for regeneration housing activities. And I guess I'm more hopeful and expectant now that the new regulations will have a much lesser impact than as it started out. And indeed, we've had clear notifications around, for example, companies and the intent not to cause MRP issues around companies, because companies have to make depreciation. If they also have to deal with MRP, then it's effectively we're putting at least 2% on top of their interest rate, and then they're having to depreciate as well. So this is kind of like it's a very complex area, and they certainly wouldn't want to stop at, I'm sure, well, in there, we don't want to generate unintended consequences. They wouldn't want to stop strategic development locations and housing delivery, which of course is a national objective. So that's the long and short of this is we're still in the same place we've been for the last goodness knows how many years. Still, it's about the prudential code that gives discretion to local authorities, and local authorities in the main use those discretions. There's very few, and maybe there may be none, that adopt that purist approach because it has an obvious impact on the council taxpayer, and therefore by paying off the debt in the most speediest of way, that means you're putting more pressure on the council taxpayer and therefore pressure on money available for service. So it is a balance, it is a risk. I flagged up the risk around these changes in last year's CFO report and this year's CFO report. It's not the biggest risk, I would say, on the CFO report in the context of financial well-being, but it is a sizable risk. And within MRP, the biggest concern I would have would be around strategic development location delivery. But of course, it does impact on housing. Our housing companies could impact on our housing companies and indeed holding commercial properties.
Okay, thank you. I think I read that they were planning to introduce it in April this year. Presumably that's very unlikely.
Oh, the earliest the statement, most recent statement is the earliest it will be implemented is April 24. But you might well be right. At the very beginning, it might have been April 23. So it's not even sure it will come in April 24. That's the earliest. And we don't know what it is. And what we obviously will do is respond to the Treasury Management Strategy of 24-25 if indeed any of this becomes clear.
Did you come on?
Yeah, I'd just like to follow up on the statement that it had at the beginning of the consultation, which talks about the existing requirement for MRP. And it says, and I'm quoting here, local authorities are charging debt related to certain assets. The evidence is that while some authorities are making MRP for commercial investments funded by borrowing, some are still not paying MRP in relation to borrowing associated with investment assets or capital loans. The statutory guidance is clear. This is the current statutory guidance. It's clear that financing for investment assets and capital loans requires provision to be made. In terms of WBC Holdings, it has net equity at 31st of March 2022 of £500,000. So there's not much wiggle room there, and I am concerned about capital loans should the assets need to be written down. And I just want your view on why the consultation would say that the current guidance is clear that you need MRP on investment assets and capital loans, and yet we still don't provide them. Thank you.
Okay, I guess my position is backed up by Treasury Management Advisors. So Link we use as our Treasury Management Advisors, and they deal with an awful lot of local authorities in the country. We also, of course, discuss these issues with our external auditors who put in the accounts that our accounts were provided using the appropriate I'll try and find the exact words. The accounting and the preparation of the financial statements is appropriate, and they were prepared in accordance with the Code of Practice on Local Authority Accounting in 2021. We also have a team of specialists, two of which you'll see on the screen, and they go to conferences and all sorts around Treasury Management Practices, MRP. And of course, I'm acutely aware of across the country, there are an awful lot of local authorities that have taken a similar interpretation to us, which is why I am sure the consultation has carried on for 2.5 years. If this was straightforward, and if this was as you described, it would not have taken two sets of consultations, almost 2.5 years for revised guidance come out. And if it was clear, why is there need for revised guidance? And furthermore, when we undertook our MRP policy or put forward our MRP policy that went into our Treasury Management Strategy, that came from barrister's opinion and actually came from barrister's opinion of another local authority who obviously will be relying on that barrister's opinion as well. So I just really stressing it's not clear at all, and the statutory provision is set out in the Prudential Code, and it hasn't changed. And the DLUC consultation that initially came out in that way described has changed significantly over the duration of the last 2 years.
To come out? No? Okay. Any other points on Mike?
Sorry, it's the same area. On page 162, you have a table of expenditure type and what the MRP charging policy is for WBC. The text above it says that it will follow DLUC principles except in some instances. It'd be really helpful to me if there was a further column which told me what the DLUC values were for these things that we are not abiding to. So I don't know the scale of the departure from the guidance.
But I think, aren't we saying that we don't believe we are departing from the guidance? So there isn't anything to put in there at the moment until we know what the new rules are going to be.
It says the table below summarises where WBC are planning to treat MRP different from the guidance. Yes, that's all of them, but I don't know what the guidance values are. So I don't know how far we're moving away from the guidance in accepting these departures.
Okay, I mean, I don't know what extra work that would be for officers to put that in. I see what you're getting at. And we're within our right to depart from the guidance, but is it possible to put a value to that? Graham, Kate?
Yeah, I was just going to add for members, on the 30th of March, we presented the audit report for the closing accounts, and on there on page 41 is the confirmation of our external auditor's view on our MRP, which confirms we're acting within the arrangements that are allowed, which are around making a prudent provision. I think we can add details of what that guidance is against each of those categories, or certainly we can show what categories it gives specific guidance around. So maybe that's something we could just share with the committee. Okay,
thank you for that. Any other points from members on Treasury Management? No? Okay, we'll move to the recommendation then. So as Graham mentioned, we are asked to support the Treasury Management Strategy and recommend that the Council approve it. So are we all, can I see all those in favour of that recommendation? Okay, that's carried. Thank you. Okay, so we are coming to the end of our agenda. Just in terms of the forward plan, which we don't have in our pack. So for the next meeting in March, we have obviously an update on hopefully the sign off of the statement of accounts for 2021. We've got an item on the SITFA Code of Financial Management. We've got internal audit update and also internal audit plan for 23-24. We've got complaints and compliments, I believe, and also the annual report for the Audit Committee. Have I missed anything off? No. Okay, so that's the forward plan. Any comments on those? No. Sorry. Is that internal audit charter? Oh, okay. We've got internal audit charter as well as the other two potentially coming as.
Yeah, sorry, Chair. I think that'll probably be presented as part of the 23-24 plan.
Yeah, that's subsumed within the plan. All right. So, sorry, Mike, go ahead.
Do we have a list of the future dates of the Audit Committee during the year?
We do, yes. We can devise those.
Do that.
We do. We signed off, I think, at the last council meeting.
Okay, if they could be forwarded. Thank you.
Thank you. All right. Well, thank you very much to all the officers that have joined us this evening for your reports and your contributions. And thank you to members for your contributions to bring the meeting to a close. Thank you very much.
Thank you.